All right, we're live. Welcome, everyone. We're here with Stefan, Ron. Alex Felix has joined to listen in. We were just kind of having a discussion around some of the regulatory issues with Etherisc, but also wanted to through kind of updates and what we've been working on over the last week or so. So the regulatory discussion was around, first of all, like one strategy that we have is applying to the UK's FCA sandbox. And then another interesting vector that was brought up was a mutual company structure, which if you look it up on Investopedia, a mutual company is a private company whose ownership base is made of its clients or policyholders. The defining feature of a mutual company is since its customers are also its owners, they're entitled to receive profits or income generated by the mutual company. And so it would be interesting to get some legal opinions there as to the viability of putting kind of our perspective product into that structure. And I think there's to be some work done there. Do you guys have any other comments on the mutual structure?
Well, I love working on the business model aspects of things like that, so I'd be happy to interface a little bit and put together some pros and cons if that would help.
Yeah, that'd be really cool. So just to kind of recap, I think the majority of our time since our last meeting has been devoted to the white paper. I think we've made quite a bit of progress on it from the standpoint of, first structuring out the different sections and then the abstract and trying to kind of mold what we're doing. One important aspect of that is that we're zeroing in on a token model. And I think we as a team came to the conclusion that RSC tokens, as they stand today, are not really going to be kind of technologically compatible long term with what we're trying to do, and that we will need to probably migrate to a different token at some point. And so we communicated that in an announcement a few days ago. Does someone want to kind of give an overview of how that will work?
Before the overview,
where
are teammates or participants or advisors to the project eligible to buy the HKG tokens to support the project?
I believe they are. That's a Stefan question in general, but I think anybody is free to go ahead and purchase HKG and then subsequently purchase RSC tokens. Does that make sense?
Yeah, I didn't want to go out and purchase a bunch without knowing whether or not it was okay to do so.
Of course, no. We don't know.
Right. So actually, on that front, if we can just go ahead and, oops. We can go over here to our camp. As a matter of fact, we've been doing quite well with selling tokens. We issued 100 million RSC at a price of 0.001 HKG, and that has completely sold out. Our next round of 100 million at double that price, and so we kind of expect to keep doubling the price at every 100 million block. And as you can see, we've done about 125 million RSC today. Does anyone, do you guys, like Renat, how are you doing? Do you want to give some updates from your end? I know you were working on the social campaign.
Yes, I can give an update.
from my end. So the early experiments with campaigns going extremely well, I would say. I'm a little bit surprised. Here's the first results we've got. So we ran. I decided to start very slowly and run a test on two things. One is the first tweet in the bits of wisdom type tweets. So first, I wanted to start very carefully with just promoting one tweet to several audiences, and the audiences we targeted were the Ethercamp community, so followers of Ethercamp, of Roman, followers of CoinFund, of UJake, of Etherisc, right? And second audience was the followers of Ethereum project. And the first tweet I promoted was the one that there was the competition one, and the second tweet was that the bits of wisdom, and the third tweet was that the first round closed. So the last one that is been running since day before yesterday on the closure of the first one, we received so far 116,000 of impressions across these audiences, especially the biggest contribution to the audience was those who search for Ethereum and Bitcoin.
Did you say 116,000?
Yes.
Okay, that's quite a bit.
Yeah, that's quite a bit. And so overall, after tuning the some of the campaigns, I lowered significantly the cost per click that we're willing to pay. So now we went down from the first test that averaged €3 per click. That was when we let the Twitter set the price, right? So recommended bidding. So essentially, the Twitter would try to optimize for number of clicks, right? So the price then was around $3 per click, €3. We decreased it by a factor of 15. And the cost per result right now per click is 26 cents compared to €3. And that's the 26 cents on this 116,000 of impressions. So we got about 200 links, 200 clicks on the link that was promoting the camp page on Ethercamp website. Announcing that yes, we closed the first round of funding, and then the second one is coming. So that's the update from my side by looking at the campaigns, and so I'm gonna continue the experiments before ramping up the promotion. We can target a little bit more audiences. Right now, I have a few more audiences that I've been collecting through the audience.com tool that I've used. It used to be called Social Bro. It's a paid subscription, so I kind of piggybacked on the existing subscription we have at the company. And I'm collecting new audiences to target, which will include investors, notable investors, and thought leaders, which have a significant amount of followers who are fellow investors as well. That's an update from the funding campaign. Other than that, I've been researching the town crier trusted data feeds, how we can integrate it potentially with confidential transactions of Hyperledger, and make it work on to sign more complicated Oracle events. Moving forward, potentially I will add this into the white paper, the sections on that. And I have a few items to add to the white paper. Some sections that I would like to suggest include sections on interoperability of the solution, around security of customer data, on the architecture of the application, on the incentives of various participants. What else? And on how we can potentially implement treasury controls for advanced investors using multi-signature. So these are some of the elements that I've been researching, and potentially can add into white paper if you guys think that these are in line with where we're going. What do you think?
That's great. That sounds like some pretty good progress. Is there a way to measure like how the social engagement actually translates into engagement with the hackathon at all? Like I know we definitely have seen you know, an increased activity in terms of purchasing tokens. We've also had a couple of votes come our way, but there's no particular way to like tie a causality between those two things, right?
Yeah, well, there are bad news in there. The bad news is that with camp with the camp website on other camp, seems we don't have like complete control to add some JavaScript goodies in there. If we could drop it, it would be great, or we could be much more transparent into what exactly which pieces of campaign contributed to which even funding events. But it's probably a stretch to expect that. If we were to for the campaign that if we were to have some conversion events and call to actions on the website which we could control, then we could tie the investments with the outcomes, and that would ultimately allow us to link the specific campaigns and to investment outcomes.
Gotcha. Cool. I guess one thing that we can kind of discuss is, you know, we as a team kind of got together to try to think about the token model. Like I mentioned, I think we settled on the fact that our token economics is going to need some extra facilities from the token. So we envision that as something called an RSC FDD token. FDD, of course, stands for Flight Delay DAP. And I can even share, I think, from our white paper, kind of the high-level diagram of that. And so one thing to remember is that, you know, as this project goes toward a crowd sale, you know, in very typical fashion, a blockchain crowd sale collects funds for the purpose of development. In our case, the goal of our crowd sale is actually somewhat different. It's actually to put collateral into the reinsurance pool of our insurance product. And so I think it's still an open question of, you know, whether 100% of the crowd sale funds are going to go there, but I think we pretty much all have agreed that the vast majority of those funds are going to be going to the reinsurance pool. So to give kind of a rough idea of the pieces of the application, you know, here you have your risk pool, which is basically a smart contract, probably working with you know, collaboratively with a program that sets certain parameters in the smart contract, such as calculating premiums through a model, etc. Customers will pay premiums to that contract. They will go into the risk pool. When policies expire, payments will then automatically, as has been demonstrated by the flight delay kind of alpha prototype, will just automatically get paid out. And you know, within our risk model, as we mentioned in previous meetings, you know, we have this mathematical expectation of revenue. That's because we expect that the number of claims that will be claimed, you know, on average under normal circumstances, will actually be less than the collateral that we will collect from premiums. And so we have this excess revenue. Some of that excess revenue is going to be paid as fixed costs. You have to pay service providers for data. You have to pay maybe some portion of that revenue going toward further development of the platform. But there's definitely a non-zero kind of minimum technological fixed cost there. I think the majority of that revenue would flow to RSC AFDD holders pro rata. And kind of in our model, I'm thinking that there'll be a stream of revenue that will also perpetually kind of go to fill in the reinsurance pool. And so the way that works is, under normal circumstances, we're basically here. We're writing policies. Those policies are expiring. The excess revenue from that is just paid out as dividends. But in the event of a long tail risk, and this is kind of a key point, we will only write as many policies as we can reinsure in the long tail. And so what that has a really nice property that the customer basically in the system will not be very likely to lose money, if likely at all, because of 100% collateralization of their of the liability created by the policy. And so if a long tail event does occur, and if that event drains this reinsurance pool, this sort of like minority revenue stream kind of makes sure that over time that pool is replenished. And this pool will work in concert with the RSC FDD supply. So what that means is, at a certain amount of collateral here in the reinsurance pool, we'll be able to write N policies. But we can imagine that, for example, eventually demand increases for policies, and now we don't have enough reinsurance capital to guarantee 100% collateral there. Well, in that case, the reinsurance pool can actually issue some new tokens. That, of course, implies a certain amount of dilution for existing token holders, but if you actually work it out in practice, the numbers seem pretty promising, because we're able to price these tokens really at like a mathematically fair price. It turns out you wouldn't actually need to issue like enormous amounts of tokens to get back that collateral. And so I kind of see, these pieces of the back end here, if you will, kind of connecting to a front end, which is a token marketplace. And that token marketplace will just simply have an auction of tokens as they become available. And then conversely, if this revenue stream ever overfills the pool, so now you have actually excess capital, you have the option of, or I should say the contract has the option of actually buying back tokens. And so on average, you have, you're trying to have like an average, kind of a stable supply there. Now for, tentatively subject to change, but we're trying to work in the current RSC holders, like how do current RSC holders, what is their relationship with the crowd sale of these new tokens? And I think there's a bunch of options, such as giving those holders kind of early preference or price preference, or just simply giving them a certain amount of ownership in the initial RSC FDD supply. Like the details of that are TBD, but I think that several pretty fair and equitable schemes are possible in there.
Jake,
Maybe,
how do you foresee covering operational costs?
So Ron, again, so some portion of revenue here is going to go for operational costs. I think I think basically operational costs, and if Stefan and Christoph are there and want to chime in, basically could be divided into two parts, right? So the first major costs are R&D, which is kind of like hiring developers to get the prototype out, et cetera, doing some research on these models, doing research on how to connect, like an off-chain computation service to the risk pool contract. The other kind of cost, again, this is kind of my opinion from the side, is probably paying providers like I think flightratings.com is the provider that the current alpha prototype uses, and I'm sure they charge for access to the API.
What about marketing and customer acquisition?
That's a great question. So that's a question probably better for Christoph if he wants to chime in.
Yeah, I would say I see the major operational costs on the inside of the model is that you have to continuously adjust the risk model because the risk model will contain some parameters, and you have to validate these parameters. In my experience, there is no risk model which will run forever without intervention, because risks are changing and the correlations are changing, and you have to account for this. So there are some fixed costs for the continuous development of the risk model. That's the one side. Then you have maybe security issues, and you have to do work on the front end and so on. And there are Ethereum will evolve, and there are new issues from this, and you have to. So maybe you have to migrate the whole contract on a regular basis, and so on. So there are fixed costs for the internal support and development of the contract itself. Yeah, it won't run completely autonomous. You have to care for it like a gardener. Yeah, so you and this will be a significant cost, because you need some experts, and these experts are expensive, and so you have some fixed costs just to keep the model stable. Then of course marketing is an issue, because I think in what we have seen in the last ICOs, that marketing is it's a, how you say, is self runner in German. So these ICOs, they did not much marketing, except from doing some social media and Reddit and Twitter.
Viral.
And so on. Yeah, viral, mostly viral, and maybe we don't need much marketing. But if we want to go on a broader public adoption, then we of course will need marketing, and so this will be another big bunch of money which we need on a regular basis, and. Maybe there are some other costs, for example, audits, security audits, or even and the whole legal side. Yeah, maybe we need some legal advice. Lawyers are very expensive also, and these all accumulate to a certain amount of fixed costs, which are absolutely, maybe they are high, but if the whole model will scale, then these are mostly, compared to the overall volume, these are fixed costs. Yeah, I do not need twice the costs of lawyers if the volume is doubled. So I think these costs will stay on a fixed level, and if the whole volume scales nicely, then this fixed cost will be very low compared to a classical insurer. That's our assumption. Yeah, and otherwise the whole model wouldn't make sense. Yeah, we want to be much cheaper than a classical insurer, especially in the fixed costs. But we need them, and we cannot eliminate them completely. And I think as Jake has painted it, they are deducted from the risk pool, and they are a certain part of the premium. Yeah, but a fixed one.
I think Christoph, it's also interesting to think about kind of maybe like how the product, when it's in a completed form, interacts with end customers. And what I mean is, if you go and try to market directly to end consumers of the insurance, that's one marketing problem. Yeah. If you create a partnership with a large insurance organization, you sort of automatically create opportunities for marketing to their existing audience. And so
of course.
The marketing costs there are different. How do you? I know we touched upon this, you know, a little bit before, but how do you see Etherisc kind of getting out there in the market?
Well, we
Can you
haven't
hear me, guys?
we haven't yet. Hi, Stefan.
Yes. I'm I'm not sure if you can hear me nicely, but
Yeah,
I'll try.
hear you.
So basically, the model should be to target large partners first. Yeah. So we have been contacted by a few travel agencies, online travel platforms. Now we've been contacted by a car insurer. Yeah. So those large partners could help us distribute a consumer solution nicely.
Well, no doubt that there's going to be ongoing operating expenses, and the direction that I was trying to explore was the ability to have one token support the company and the other token to support the risk that the company takes in the policies it sells. So that's the kind of distinction I was trying to make. If you want to invest in the overall growth of the company, you think the company can scale, you think it can grow far in excess of its, you know, consistent operating costs, for example, and extraordinary returns might accrue to the growth of the company, as opposed to an above normal rate of return for taking on the risk of insuring the products that the company provides and insures. I think those are two different functions.
Yep.
One supports the company almost as an equity. The other is more like the bond that makes cash available, hopefully diversified, uses it to provide insurance coverage and receives an extraordinary rate of return, but does not have any participation in the growth of the company, just a return based upon the amount of insurance coverage it provides.
Exactly. We have discussed this exactly in this way, that we one option would be to have two coins, and two coins which we will stay two coins. One coin as maybe comparable to an equity, and one coin comparable to a fixed bond. And we were not quite sure if this model is acceptable by the investors. And so we had this other model that we start with two tokens, but that we finally merge these two tokens in one, and that we use the first token, for example, the DST RSC token, as we have it on Hack Ethercamp, that we use this token to finance the development of the model. And then on the long run, we have only one token, and we finance fixed costs or operational costs out of the premiums. And so there is no, there are only one token on the long run, and it's more simple, the model. And I think it's more democratic in a certain sense, yeah, because you don't have the company owners on the one hand, which earn their profit from the growth of the company, and on the other side you have the investors in the risk pool, which get their revenue from the fixed maybe fixed income from the excess premiums. So we are not quite sure which model will be acceptable by investors. Maybe we can discuss this now. I think it's an interesting question, and I think these two options they are present, and there are advantages and disadvantages on each of these two models. And I would like to hear all of you what you think about it.
Well, if the option is to go with a single token, I could see that the token is constructed such that the first X return above the cost of underwriting the policies, including some estimate for marketing and growth and customer acquisition costs would go back to the operating company, and then everything else would go into the risk pool. What I think it's important to prevent the investors from controlling the ability of the company to grow itself, meaning you could have an investor that says, wait a minute, I'd really rather have a 7% return and only write 100 million in policies per year, where the company may say, we'd rather pay a 4.5% return, but attempt to sell 500 million in policies per year. And I'm trying to figure out how to balance those two misaligned potential incentives.
I think that's a great point you are making, Ron. So what I'm just thinking right now is there is a reason that bonds and equity exist as different asset classes, and maybe we were always trying to find the one model that suits all needs and try to come up with a nice balance that can handle this very different incentives. But maybe just having two tokens is the better option and the cleaner option here. So
it certainly bears discussion. I don't think it's obvious to go one way or another at this point. And Jake, I mean, I'm not sure about the Howey test and things like that, at least in the US, whether just a pure risk-based token without governance attached to it would satisfy a non-security test.
Well, again, I'm not personally a lawyer, but my sense is that, looking very, very much like a bond, having an expectation of profit, certainly through the toil of third parties, it doesn't look good in the U.S.
Right.
But if you're in a sandbox or if you have a large market outside of the U.S., that might be an acceptable from the solution from the standpoint of the business model of the company. I mean, after all, this is not like a U.S.-based company.
Right.
So I was, I'm kind of thinking that like the one token model in the long term, right, where everyone is just, the company and then investors and then potential, buyers in the market, where they're all, kind of having this risk token and they're getting paid dividends. I think that seems to be kind of the most equitable thing. Every party in the system, is sort of on the same ground. And from that standpoint, it's almost like if you could get initial seed capital to kind of build the product, get it out, and then see it produce revenue, and then take your seed investors and actually convert them to that token, that might be a way of getting there. But I think there's also like a longer term question of like, I think development is something that's going to happen perpetually over time ad infinitum. And so that development initiative needs to get funded. And the question of whether it should get funded through a digital fundraising or a more traditional fundraising, I mean, I think that's an open question, and it has like pluses and minuses.
Right. So is the investor side a risk-only investor, or are they risk and governance?
Well, if you're selling kind of seed or equity in a seed round, governance is going to come with that for sure. If you're doing a token fundraising, then you have, I think, these other kinds of questions like regulatory status of a digital token that is purely an equity-based token. Does that give you governance? If it does not, then what is sort of the investment proposition? Kind of like my point is that, since there's one source of revenue in the system, it's like eventually everybody has to bank on that source of revenue, whether you're a customer, whether you're an investor, or whether you're, whatever other participant in the system. So it's like, it kind of in a way doesn't make sense to me to create an equity token that also gives you rights to that revenue stream, because the rights to that revenue stream, all in all, I think should be should be with the RSC FDD token holders and period. So from that standpoint, I'm kind of thinking like maybe a seed investment would work better in that case. You get some equity investors, you sell them kind of a convertible equity, which after the product is out converts to RSC FDD tokens, and then they're kind of like on the same footing as everybody else. But I mean, this is just like random thoughts.
Yeah. Hey, Stefan and Christoph, have you thought about what the budget looks like just to launch the product on a commercial basis? That is it 4 developers, 5 developers, you know, 400,000 or 500,000 a year plus marginal costs, or 200,000 a year plus marginal costs? Like, do you have any idea of what it takes to get, you know, X policies under risk written?
Well, it's very difficult to answer this question because, for example, the flight delay prototype, this was some weeks work, and now it's running without any intervention. It's completely autonomous, and it does not need much work. I think it depends very much on how much effort we need to market the whole thing. I think the technology and the front end and the contract, this is one-time costs, and then the interesting question is how much effort we need to get these policies written. Yeah, and I have no idea. Sorry, I have no idea how fast this will be accepted, how fast we will get that sold. I see much interest, and as Stefan said, I think it depends on whether we get some large distributors which will integrate this solution in their existing products, and then we will be successful. I think the crypto community itself there are many people, but it won't be 1,000 policies. Yeah, and so we need some strategy to get it in a broader scale, and there we need some big partners. And I think we are talking to some of these, but they are, as every big partner, they are very slow. They have long decision processes, and so we should start to talk with them, but that will not go fast, take time, and I think we need 2017 to promote the whole model, provided we have it running. So this should be the first goal, that we get it running, that we have a working system, and then we can present it to some big partners, then integrate it in their solutions. We have to solve the problem of cryptocurrencies. So these are many interesting problems we have to solve, and I don't think it will go from itself. Yeah, and I have no idea what strategy will be the most promising.
So I think Ron brings up an excellent point here, and I think the budgeting of this thing is probably something that we should go through and be ready for when you sit down in front of an investor. I think like it's not really, the conversation can't be that productive if you don't have that number. But the luck,
luckily, just to say one number, we have currently we have a similar project with a paying customer. It's a private blockchain, and it's the realization of a certain business process. And so we can estimate how much the development of such a model, as we see it, will cost in reality. And I think it's between 100K and 200K. Anywhere in between. Maybe we need some more, maybe we need a little bit less, but I think this is a number which you will see there. And so this would be a number which you would tell to a professional investor. And so we are not very far. If we are very successful, for example, in Hack Ethercamp, then we come to such a number, yeah. And if we get, for example, we get somehow something like a third or a sixth of the volume of Hack Ethercamp, then we have it, yeah, and we can start. But then we have to convince our investors that they vote for our proposals. So that's also not easy, yeah.
Well, so I recommend that we as a team kind of go through the exercise, and I'm sure a lot of people sitting here have plenty of experience with this, where we can just say, ideally, if we were to try to build this prototype on let's say 3 to 6 month time frame, we definitely need a smart contract engineer. We need like a full stack engineer. We need a security review for the smart contract from the Zeppelin team. We know how much that costs. We know what the costs are from Oracleize for data feeds. We have the following, off-chain computation solution. We want to spend blah, blah, blah on marketing and, Twitter campaigns and advertising, and putting that all together, I think you'll arrive at some kind of middle number. It might be higher than kind of what you're thinking as a super lean project. But also if you put it in front of, a good investor, it might not even be very much for them. So I think it's important to kind of have a thorough, like, broken down idea of what I also don't think it's going to be.
Yeah, I talked only on the technical costs, not on the marketing costs. I have no. This will be for sure. This will be a similar number than the technical development.
Mm-hmm. And we also need an understanding of the potential market size. What is the total amount of policies that might be sold in the best case? Is it $10 million worth of flight delay insurance or $100 million worth of flight delay? Understanding that this is just a template, but you still have to dimensionalize some customer acquisition cost and processing cost besides the risk cost, which I think the model is giving us a very, probably our most accurate idea of. And then say, okay, investor, here's the business proposition. It costs us $5 to, process a policy. We end up earning about $12 on a policy. We give $4 to our investor pool, and that leaves us with $3 or $4 left over, which we can spend more for marketing or do more development and stuff like that. So we need to understand the cost side as well as the potential market side. And it wouldn't be a bad idea. Like I know the first thing is flight delay because it's a great template. The second would be crop or land insurance for crops. What are the third and fourth use cases that you guys have been imagining?
Well, I think we just today we talked to some insurance guy, and he proposed that we should also take into consideration a mutual insurance model. So on the one hand, it has regulatory advantages because in the UK and in the common law legislations, you don't need an insurance license for mutual models. Yeah, mutual means that the claims you have no right to claim, but you can only appeal for a claim, and then the other participants have to vote for you, and then so this is not an insurance model but a mutual model. So we could also think about extending our current model in such a mutual model, especially if we want to or if it turns out that we need a license, and getting a license is a very big hurdle if it turns out that we need a real insurance license, and to turn our model in a mutual model would solve this problem, for example. So we could think in this direction. Then if you have a mutual model, then you can also think on all kind of damages in the house, in the living environment, for example, household or everything which can happen there, and because then you have claims management where you have people which can assess claims, and this could be further extensions to our current parametric model. But I think these are still somehow in the future, because they are much more complex than the simple parametrics case.
We're also considering health insurance, life insurance, so social insurance even. Yeah, so we've been thinking through several of those verticals, not in depth, but there are several options to expand.
Guys, I think about the next products from a little bit different perspective. If you think that what is that the decentralized autonomous or semi-autonomous model, what kind of inherent advantages does it have against the both the business model and the capital model and the value chain of incumbents and existing products out there, right? I think that if we look at what exactly the core source of value is, the ability to securitize the risk at the point of distribution. And if we look at that, if we all agree about that, then if we evaluate all of the different products, regardless of how you, whether it's an insurance product or whether it's mutual product, whether it's parametric or not, if you look at it from a perspective of what might be the biggest gains to be had for the consumer, right? If we were to securitize the risk at the point of distribution, and we compare all the different products out there, both from within the parametric types of products, such as, for example, weather dependent risk could be different. It could be for cities against flood. It could be weather based products for travelers, right? Hotels offering automated payback if there is no sun, right? We could go into property casualty and annuities and for when it comes to life insurance product. But I think we could have a spreadsheet where we could rank different types of products on the impact and the upside for the consumer. What kind of value, what kind of upside is there for the consumer compared to the traditional model if we were to securitize this risk at the distribution point? And the cost of getting the distribution is also one of the parameters, one of the factors to compare that. So taking the quantified approach towards selecting the next products, I think that's what I would suggest that I would do.
Yeah, and very very easily we could put some like concrete numbers on that. You know, in the U.S., the insurance sector is generally divided into two pieces, which is life health on one side and property casualty on the other. So at the end of 2014, the life health sector reported approximately 354 billion of capital and surplus at the end of the year, and comparatively, the property and casualty sector reported 689 billion in surplus. And so you see that like property casualty is like 2/3 bigger really than the other kind, and it seems like that would be an interesting area to focus on. Cool.
I mean, revenue is just one dimension, isn't it? If we think about social impact, then something like social insurance or unemployment insurance maybe even has a higher impact.
Yeah, and especially the new products that you can create with it that are simply out of reach for existing players, and no one does them because there is no money in there.
Exactly. Yeah. I read the other day. I read a nice quote. If it doesn't get people out of poverty, it's neither revolutionary nor disruptive. I like it.
That's very interesting. If you could provide an unemployment insurance product that competes with, you know, government unemployment insurance and hell of a better job. I think that would be a very interesting.
Well, I think it's cool to talk about the 2027 business opportunities for this, but I think we ought to cover 2017 and 2018.
Yeah, well, let's not get the big vision out of hand here. Yeah? So if you remember the Dynamis proposal, that was exactly about unemployment, and actually Joshua had a very good way of tackling that with stepping into the LinkedIn API, which is an interesting approach. But I agree. So Renat, I like very much your proposal of quantifying this and basically doing some thorough analysis to decide that what is the next product to go into once we have our technical setup working. I think so far we have been focusing very much on getting it to work from a technical perspective, and this call really opened my eyes for putting more effort on the business development side of things.
Yeah,
we have good business developers at hand. Yeah, so I would like to bring in Tomer. He has volunteered to help us with business development. He's from Israel, a really good and very clever guy too. So there are some options. I'll think about it.
So shall we take it as team action items to add to our white paper, kind of quantified next steps for insurance verticals, and also broken down kind of estimate of development costs?
Even more important is the cost side and the market side, like Ron said.
Mm.
So we need to have a good estimation on the costs needed for development, and tackle the flight delay market as the first one, and then have this decision table on where to go next. Basically.
Yeah,
that's my view.
I think the first step could be that we set up a little spreadsheet, and then we simply collect all the topics which we have to cover. Yeah, development, marketing, audits, and every estimate is better than nothing. So we can't be so wrong. But we have to collect these numbers and make some good assumptions, and then we see the big picture. And otherwise, we are just talking, and we are not getting the something tangible. And so I would propose that we open a spreadsheet, we put it as an appendix in the white paper, and we can work on it, and then we can discuss. And I think if till tomorrow or till the weekend we have something which is better than nothing, and I think we should start that.
So my question is, what is the mission statement for Etherisc? That is, is it providing lower priced insurance, providing new types of insurance, or is it providing investors the ability to participate on the sell side of insurance? Do you have a priority to them?
Yeah, I would say the most important thing is that we democratize the whole segment of insurance, because we open the investor side to everybody. We open we lower the costs, and everything is a consequence of disintermediation. So we should put that in the middle. That we are cheaper is not so important, but it is a consequence. Yeah, it's a consequence of making it essential. It's a consequence of reducing the costs and so on. But it's not the most important thing. The most important thing is that we open the whole business, and we allow participation of a much broader range of people in the whole process, and participation on the one hand on the economical side and even on the operational side. Yeah, if you think of a real mutual model, then you can participate also in the business processes, which is also very attractive.
Interesting.
I agree.
Okay.
I feel like playing up the the democratization of access is, to me, like the more compelling side rather than efficiency.
Yeah.
I would really start with cutting out the intermediate. That's the disintermediation is the start.
Sounds good.
All right, guys. Well, it's all great ideas, and I fully support you all with such noble goals. Let me share with you the spreadsheet for quantifying the pipeline. I make it anyone with a link available to edit, and we can start with that. So one aspect I would like to propose and discuss right away is that here's the link for everyone in the chat.
Okay.
I would like to propose the normalization of costs. Essentially, like if we look at the for example, $1 million as a budget, right? How about we use essentially measure all the costs to be relatively correct? We assume, we just say, okay, the normalized cost of marketing, for example, the normalized cost of compliance or regulation, like getting a license, or for example, for some products we may need to buy insurance fronting, right? License in the certain markets. So normalized cost might be, let's say, $250,000 in the US. That's what it may cost to get, let's say, a license in a certain state or several states. If you were to buy it, if you were to buy it as fronting, right? It might be, for example, 5% or 10% of your, for example, premiums. So for $1 million in premiums, we're talking about $50,000. So the normalized cost of regulation licensing in case of insurance fronting in this point will be 5%, because it's $50,000 compared to $1 million. So if we were to normalize the costs, we would be able to later rank and filter down and rank different products by their attractiveness, cost of distribution, cost of marketing, cost of regulation, without getting into hard numbers, which might be also having a ranges, right? It might be, it may depend from 50 to 500, right? How do you do that? So that's kind of what I would suggest. What do you guys think?
That makes sense to me.
Good framework, good start for sure.
Okay.
I would suggest maybe also putting in some kind of measure of like market size for that particular class.
Okay, cool. That would be one of the first actually things to go,
Yeah.
Market size. Okay.
Good.
Yeah, this looks good.
Sounds awesome.
Okay. So I would suggest we go after a bunch of parametric. I can add what I've been working on for the portfolio. One of the unfinished item I have, it's so many things to do. But one of the items I have out of the research I've done is the list of low-hanging fruits when it comes to parametric. And some of them are policies that are completely like weather dependent, but there is a whole family of those that we can offer, such as products for the construction industry, essentially business disruption policies. products based on weather for the travel industries, where hotels buy production and offer essentially a new customer experience where they guarantee a payout, let's say $50 a day if there is no sun, right? So Hilton hotels, that's what I've been writing up for potentially the white paper. Suggested new topics are some of these new products that currently do not exist, okay? And I see a long tail of these products as the one of the outcomes of this vision to be fulfilled is that there is a way to build those products, bring to market, and do it at a very almost zero cost when it comes to certain technology or execution, right? Once you actually put some rails. So think of it as it could be like the Amazon of risk, where certain products might be only sold in a few places of the world, and the volume is extremely small. And so having a comprehensive list of ideas for the products would be interesting, and if we can get the community to start working on the new product development, that could add a lot of value, as we could reach use cases currently not the needs of the market not being addressed by the players.
Wow, that's a great marketing outreach question as well. What would you like to see insured that's not insurable right now, and how can we address this? That's a fantastic.
Why don't we literally like run a survey? We'll post it in Hack EtherCamp Slack and our Slack and so forth. Twitter, and just get a feedback, like what is the most annoying thing, like your iPhone screen or whatever that you want to see insurance on.
Mm-hmm. All right, cool. Okay, what else? What next, guys?
I think just create a transcript of that video conference and put it as an additional chapter in our white paper.
Yep.
Okay, cool.
Cool. Yep. All right. I guess I'm gonna sign us off here from live recording. Thank you everybody for joining. Is there anything you guys want to mention before we stop recording?
That's okay.
All right. Looking good. Thanks
everyone.
Thank you.
Thanks everyone.